Hello everyone, I hope your preparation for the RBI Grade B 2026 exam is going on well. I know it is really hectic right now to balance out the preparation with respect to phase 1 and phase 2, but the best approach towards the preparation of this exam is to balance them out until at least near the phase 1 exam. But in all of this, preparing for the very important papers of phase 2 like FM paper and that to the technical part finance becomes really difficult. So, to help you out in this very thing, we have come up with this wonderful series of videos wherein we are discussing right all of the concepts which are really important from the exam point of view, specifically the phase 2 FM paper. Okay. Which are very important topics based upon the previous year questions. Okay, so this is the PYQ to concept series. We'll be discussing all of these important topics. We'll discuss all of the PYQs, right? So that you have a very good idea if any such question related to any of these topics comes in the upcoming exam, you are very confident in answering them. Okay, on that note, let us quickly move ahead and begin this session. But before moving ahead, let me tell you that EduTab has come up with a wonderful guidebook for you, which consists of the syllabus, most important topics, previous year questions right from 2019, everything that you can imagine with respect to your preparation for the exam. Also, what would be the different sources from where you can prepare for each and every paper of the RBI Grade B exam, and the six step strategy that can definitely help you out in your preparation, and you can make this part of your own strategy for the preparation, right? So this guidebook is actually available in the PDF format. You can click on the link given in the description of this video and download it. Okay, so as you can see, this is the syllabus of RBI Grade B Phase 2 FM paper, and here you can see talking about the finance part. All of these topics are something that are really important from the exam point of view. Okay, so this is the syllabus actually. So structure and functions of financial institutions, reserve bank functions, banking system, recent developments in global financial system, role of IT, non-banking system, digital payments and developments in that. Also primary and secondary market, Forex, money market, bond, equity market, functions, instruments, recent developments, and general topics like financial risk management, basics of derivative, global financial market, financial inclusion, alternative sources of finance, corporate governance in banking sector, union budget, basics of accounting, inflation, all of these. Okay, so we have analyzed very properly that what are the most important topics out of all of these things, because preparing everything right now before phase 1 might not be possible for you. So here are some of the chapters and the PYQs that we'll be discussing in all of these chapters. The timing for this video is 2 p.m. right on these days, like 11th, 13th, 15th, 18th, and 20, right before your phase 1 exam. All of these videos will be over YouTube, and you can do watch them to get a basic foundation laid for your preparation for the FM paper. Okay, similar series is being run for management paper, all management part of the FM paper also, so you can go through that. Okay, so we have already discussed time value of money, bonds, derivatives, equity market related previous year questions. Now we'll be moving ahead, and this is a major part of our discussion, that is debt market, forex market, alternate sources of finance, banking system, RBI and its function. These chapter related PYQs and the most important topics, okay, will be explained to you right now. Okay, here is the first chapter that we'll be discussing today. The first chapter over here is the debt market. Let us see this question. Repo and reverse repo are tools used as part of the liquidity adjustment facility. Which one among them injects or sucks liquidity is the question that is asked. So if you have an idea what is this repo, okay, so whenever there is some bank that requires some funds, okay, so it will approach RBI. RBI is the what, banker of or lender of last resort for all of these banks. Okay, let's say a bank requires money for overnight basis. That means it needs this money just for today, so as to balance out its account. Okay, and the balances, cash balances are fine for that sake. Okay, compulsory mandatory balances like CRR, SLR, all of these balances are fine, and at the required level for that it needs some money. So and that too for the same day, and it will pay on the next day. So in that case, this particular bank can approach RBI, and RBI would be ready to give loan, right? And that loan would be of a certain quantity, okay? And that would be for what basis? Overnight basis. That means take the loan today and pay it tomorrow. And of course, RBI will charge some interest for that money being given. So RBI provides this loan to the bank. Now, bank is an entity on which RBI cannot totally rely. Okay, so there is requirement of some collateral. So the RBI will ask bank, okay, please place some collateral with me so that if you are unable to pay, then I am able to get my money somehow. So banks are required to place collateral, and mostly these collateral is government securities. Okay, so whatever government securities bank has, it will be placing with RBI. Now, let's say 100 rupees is given in the form of a loan, and let's say repo and the interest rate over here, which is also called the repo rate, is 4%. So what is the amount that the bank is going to return in the next leg of the transaction? It will be returning 100 plus 4% of 100, which is 4 rupees. I hope that is very clear. So 104 rupees will be returned, and what will RBI do then? Whatever collateral it has collected, it will return that. So bank is in a sort of way repurchasing the collateral, the government securities that it has kept as collateral. Is that clear? So this particular repurchase, we can say, arrangement in short is called a repo arrangement, okay? And the interest rate is called the repo rate. Is that clear? Now if this thing happens in a reverse manner, okay, like banks have excess money with them, they are unable to park that excess money anywhere. So in that case, what can the bank do? Again, RBI is the lender of last resort and also banker of this, but of all the banks, isn't it? So bank can actually place that money with RBI, 100 rupees. Now this time RBI, whatever interest it is paying, it is lower amount of interest, let's say 3%. It won't be equal to this repo rate. It will be lower than that because RBI does not want to give extra interest, isn't it? So it has to gain something from in between, isn't it? Whatever it is charging and whatever it is giving away. So that is the thing. Now this is given, and then RBI gives some collateral that, okay, I will pay this money back. Till then, keep this collateral. If I am unable to pay it at the right time, you can use this collateral, mostly government certificates, and extract the money. So bank will take those things, and then when RBI returns that money, let's say this is also happening on an overnight basis. 103 is returned back, then this collateral is again returned back. So that is a sort of a reverse repo, reverse of what happens in the repo, isn't it? So and again here collateral is also involved, so that's called reverse repo, right? So these if we say are something, two arrangements by which banks can exchange money with the RBI on an overnight basis. So what is happening over here? When RBI is actually giving the loan, it is injecting money into bank, and bank will again give loan further to other entities. So in that way, the money is getting injected into the economy. Now, when bank is actually placing money with RBI, so it might have taken this money from someone and then it is placing it RBI. So money is actually sucked out of the economy. Are you getting it? So here it is asked which of them injects and sucks liquidity. So obviously we can very clearly say repo actually injects and reverse repo sucks the liquidity. So both suck liquidity is wrong. Reverse repo injects and repo sucks, that is also wrong. Repo injects liquidity and reverse repo sucks the liquidity is absolutely correct. So C is absolutely the right answer over here. I hope you have been able to guess that right. Okay, so as we have seen, so that was the thing. Let me just show you related to repo. It is a collateralized lending. I will talk about MSF also, and it is used to inject liquidity. As we have seen, RBI gives loans to whom? It gives these loans to the banks, and then actually this repo rate, whatever interest rate, it is being set as part of the monetary policy of RBI, and that is something which actually helps in translating. So if the repo rate is varying, changing, and then all the other interest rates in the market also keep varying. We'll see how this happens. But yeah, repo rate has the feature of ensuring that the monetary policy is transmitted. We'll see how. Banks and certain entities called primary dealers, they can borrow. Okay, the primary dealers are the ones who directly buy the government securities when RBI releases them. Okay, and they create a market for these government securities. So they're called the primary dealers. They're specifically designated by RBI, but now for now, yes, banks and these primary dealers borrow as part of the repo rate, and this is a sort of a short term borrowing. I hope that is very clear. I'll also talk about SDF, but before that, let us talk about the reverse repo that we have already seen. It sucks liquidity. Banks park excess money at RBI, and this is always less than repo rate. Why? I already told you, this is also short term borrowing. Now, let me tell you about MSF and standing deposit facility also. So, repo is something wherein, let's say, the bank is able to borrow 1 crore. Now, if the bank needs more amount, then it has to pay penal interest and borrow as part of the MSF. Let's say the other 2 crore, it wants to borrow 3 crore in total. So 1 crore it is able to buy as borrow as part of the repo rate. That is the limit set by RBI. But if it wants to borrow 2 crore extra, then it has to borrow as per the marginal standing facility rate, which is a penal rate. Okay, and there whatever government securities the bank has kept aside as part of SLR, because as you know, banks have to maintain CRR, which is all cash reserve ratio. These are two kinds of reserves that they have to maintain, and then other is SLR, which is statutory liquidity ratio. So here, cash, gold, yes. What is the third thing? Government securities are placed as a reserve amount. Okay, so this is SLR is placed with the banks itself. CRR banks place it them with the RBI. So whatever government securities you have collected as part of SLR, those are the government securities that you can utilize as this particular MSF for to borrow as part of the MSF arrangement. Is that clear? So there's a penal rate, and apart from that, who borrows? Banks borrow from RBI. This is more than repo rate. Penal. Why am I saying this? If this is 5%, this will be 5.25%. Let's say. Okay, so higher than repo rate always, because you have to pay some penalty for borrowing higher amount, isn't it? Last resort to borrow is this MSF. And let's say they're talking about reverse repo rate here. What happens? RBI is actually placing some collateral with the bank, and then bank is actually giving whatever money excess in excess it has. So RBI, is it an entity that has to place any collateral with someone? RBI is a very fixed entity, very guaranteed entity, so it does not have to place this collateral, isn't it? So instead of removing this reverse repo rate, they have come up with a new kind of an arrangement. It is called the standing deposit facility. It is just like reverse repo. Banks keep excess money with RBI. Banks park excess money always less than repo short term borrowing. Let's say this is 5, so this will be 4.75, something like that. Okay, so that is the thing. Now, reverse repo and SDF have only one difference. That reverse repo here, the collateral is used. SDF no collateral. So that is the difference. And the borrowing is for one night. I'll talk about liquidity adjustment facility LAF now. The securities used are government securities. Okay, so here we have various kinds of repo. One is called the tri-party repo. So here we have seen that RBI and bank are carrying out the transaction, but let's say there are two banks, they can also carry out this repo transaction, but they're very much confused with certain things, like what should be the collateral, because a whole lot of set of collateral like government securities, good corporate bonds, all of these are allowed as collateral. So choosing collateral in itself is a very big issue. Then whatever money is being transacted, who will see whether that is getting paid in a proper manner, settled in a proper manner? Apart from that, who will take care of the government securities getting transferred between these entities? Okay, so their custody and management is also an issue. So these three things are something that the extra agent or a middleman has to take care of, like CCIL or NSCR, the tri-party agents. Because of that extra agent coming in between these two parties, it becomes a tri-party repo. Then the repo is for single day, but if you need money for higher amount of time, so go for term repo, 14 7, 14, 28 days. Now if you need money at the same interest rate but for a much higher time period, like 1 to 3 years, so it is called long term repo. I hope things are clear. Now talking about SDF, this is same here. There is no collateral at all. Reverse repo, as we have seen, yes, all bank securities are the collateral. Now these three things form actually a window which banks can utilize so as to borrow and place money with RBI. Okay, what are the three things? Repo rate, borrow, MSF borrow, and STF place excess money with RBI. So this arrangement is actually called Liquidity Adjustment Facility, recommended by the Narasimhan Committee in 1998 and implemented later on. So here we can see if repo rate is 5%, then this would be 5.25%, and STF would be 4.75%, something like that. So liquidity adjustment facility, the center is repo, the ceiling or the upper limit is MSF, and the floor of liquidity adjustment facility, the lowest interest rate, is STF. Is that clear? Many things I have explained related to this particular thing. Now moving ahead, treasury bill is a financial instrument which is a dash. Okay, corporate issued security, RBI security, government security issued by RBI for managing short term funding requirements, or security issued and managed by government, none of the above. RBI grade B 2019 question. Now talking about treasury bill, there are things called bonds that are issued by different entities. Okay, bonds are what, like you have given, let's say 900 rupees, then you will be getting 1000 rupees. This is promised, along with the 10% interest of this particular value will be provided to you. So this is called 900 rupees, is something which is the price, okay, current market price that you have paid, or the bond price it is called. This is called the par or face value of the bond, while this is called the coupon rate, the interest amount that you will be getting at periodic periods of time. Okay, so this is sort of a loan or borrowing that specific entities who issue the bonds do. Now the bonds can be issued by whom? Number one, by the government, right? Might be government of India or state government, or the corporates or companies, isn't it? So whatever bonds are issued by the government of India, first of all, if we talk about that, in the short term, they are actually called treasury bills. Okay, so if they are issued for the long term, they are called government securities. Now if we talk about the state government, they can issue only long term uh, bonds. Okay, and they are called state development loans, and the same thing getting extended to the companies, right? Companies can issue short term bonds which are called commercial paper. Okay, they are called commercial paper, CP. And long term bonds are actually known as corporate bonds in general, or sometimes also called debentures. Okay, debentures, both of these names are fine. So in this way, bonds can be classified, issued by different entities. Now these treasury bills are something which have a tenure less than, why are they called short term? They have a tenure less than or equal to 1 year, while long term in the sense greater than 1 year, their tenure is. Treasury bills have a tenure less than or equal to 1 year, and these treasury bills are issued by government of India, and on behalf of government of India, RBI issues these, all of these bonds, let me tell you. Okay, and the time period is less than 1 year. So what are the different maturity, or we can say tenures? Number one, 91 days. Number two is 182-day bonds, and number three is 364 days bonds. Okay, so these are the different tenures of the treasury bills, short term bonds that the government of India issues. Now can you answer this question based upon this information? Yes, government securities issued by RBI for managing short term funding requirements. C is absolutely the right answer. If you have answered C, that is great. Okay, so treasury bills, as we have seen, when the government needs money, RBI issues them on behalf of them. What are the features? If we see, there are three tenures: 91, 182, 364 days, and these treasury bills are generally issued as zero coupon. Okay, so 1000, and you can buy it at 800. There is no interest rate paid. Okay, face value issue price will be there, no coupon rate. Okay, apart from that, the minimum denomination for which you can issue these treasury bills are 10,000 rupees, and they are traded also, like you buy a treasury bill, give it to someone else, you can do that, and they are safe because issued by the government of India. There is yield that you obtain over them. Like if you have, yield is nothing but the profit that you obtain. You have paid 800, you're getting 1000, the difference is 200 is the profit that you're going to gain, isn't it? Now talking about it provides huge liquidity. Okay, they can easily be converted into cash. If you tell anyone, you can, would you want to buy treasury bill, everybody would be ready, because these are safe instruments, isn't it? Now apart from that, like you can also calculate this particular yield. Okay, so you have seen 200 is your profit. Let's say you have bought a treasury bill of 10,000 into 100%, so if you calculate that, you're getting about 2.04% as the yield. So these are the things. There are different kinds of treasury bills, like on tap, ad hoc treasury bills. These are the treasury bills that the government of India issues. On tap is whenever it wants. Ad hoc, whenever the balance of government of India reduces, it issues them in the auctions. Auction treasury bills are based upon auctions. Okay, bidding is done over them with respect to price, yield, different things. Now these two are discontinued. Oops, because the government of India, whenever it wanted, it used to issue these particular bills. The fiscal discipline was question because of issuing these particular treasury bills, issue them and get the money. That's all. Don't do any hard work in getting that income. Okay, so that was the thing that was happening. Now auction treasury bills are yield based and price based. Okay, yield based in the sense you tell them, okay, 4% profit is something that I'm expecting. Someone says 5%, whichever bid RBI thinks is the best, it selects that. Now people can also bid on the price of the particular bond, like you can pay 900, someone says I'll pay 901, someone says 920 on this bond which is giving me 1000 rupees. So price based auction. Okay, so that is the thing. And these treasury bills can also be collected as part of the and maintained as part of the SLR that we have already discussed, that in SLR, these reserves, cash, gold, and government securities have to be maintained. Government securities, which ones? Treasury bills can be maintained. The return is very low because they are very safe instruments. Okay. So risk is low, return will also be low. I hope you know that. And the settlement cycle is T plus 1, which means if you have bought this, given the deal, okay, went into the deal of buying the treasury bills on 1st January, you will get a hold of them by 2nd January, considering both to be working days. Okay, so that will be transferred into your demat account on the next working day. That is the thing. Now please try to answer this question. Commercial paper are issued for which of the following purpose? I think you can answer it very well. Okay, so I just spoke about commercial paper. Please pause the video and try to answer it. By banks for managing liquidity, government for managing short-term requirement, by companies for short-term, local government bodies, or none of the above. So the term commercial itself says this is for high profit purposes, and commercial papers, as I already told you, short-term basis these are issued. Okay, so the time period of commercial paper is 7 days to 1 year. It can be a time period between these ranges. Okay, should not be less than 7 days, not more than 1 year. So that is why these are short-term instruments issued by whom? Issued by companies. So C is absolutely the right answer. Okay, so companies, if we say, they can issue other long-term bonds also, which are called corporate bonds or debentures. Now let us have a look at commercial paper. Okay, whenever companies need money, they issue this commercial paper for the short-term basis. But there are certain conditions. Companies need to have a net worth of greater than 100 crore. Only then they can do this. Okay, companies, primary dealers, and even all India financial institutions. Okay, there are 5 all India financial institutions in India. Do you know the names of them? SIDBI, then there is NABARD, then there is NHB, right? We have NABFID and Exim Bank. Okay, so these are the 5 all India financial institutions. They can also issue these commercial papers, but these financial institutions actually have different terms. Like they can issue the commercial papers which have a time period greater than mostly greater than 1 year, 1 year to 3 years time period. Okay, so this is not short term for them, but for primary dealers and companies, when they issue these sort of bonds, they issue short term commercial papers only. Okay, and whenever the trading of this commercial paper happens, that has to be reported on this platform called financial market trade reporting and confirmation platform of the clear corp dealing system limited FTRAC within 15 minutes of the trade. Like you have online transferred the commercial paper to someone else, you have to report over this particular platform. Okay, and the settlement happens at T to T plus 1 days. Okay, on the same day, 1st Jan, you have done the deal, the settlement will happen, commercial paper in your account, your money in their account. And if you have if it is T plus 1, to at least by next day, 2nd Jan, considering them working, this transaction happens. Okay, that is the thing. So commercial paper is unsecured, there is no security behind it. Like if the other party is unable to, who has issued this particular commercial paper, unable to pay you, you can't do anything. Time period, as I said, 7 days to 1 year, and the denominations of 5 lakh and its multiples. And commercial paper, whatever entity some company has issued, let's say, and that company says, okay, I have issued this commercial paper, but I don't want to give you any interest, so I want this commercial paper redeemed back. Okay, so this can be done only after minimum 7 days of issuing that particular commercial paper. Like 1st Jan you have issued, and only after 7th of Jan, okay, considering all working days, this can be done, that please return my commercial paper. Okay, so the buyback, this is called the buyback period. So buyback period is at least 7 days. Okay, only after 7 days you can do this. Apart from that, it is issued at discount. Okay, same thing, like it is going to give 1000, you have to pay 800. So this is issuing at discount so that you get a difference profit of 200 at least on this commercial paper. One very important condition, adding to the condition that companies need to have a net worth of 100 crore, sorry, the company should also have a very good credit rating, at least A3. Okay, so A3, A2, A1, these are like the credit rating which give an idea how good the company's financials are. So companies which have credit rating A1, A2, very good, they can issue commercial paper. A3 also, but not companies which have a credit rating B or C, they cannot issue the commercial paper. That is the thing. Okay, now moving ahead. Commercial paper can be issued for a minimum of dash number of days. You know the answer to this. We have already discussed. Please let me know the answer. Okay, pause and let me know the answer. Yes, if you have answered B, that is absolutely right. Already discussed. Now moving ahead. Commercial paper is unsecured short-term loan taken by a corporation typically for financing accounts receivable and inventories. It is used at a discount reflecting current market interest rates. It's also called unsecured promissory note. Okay, so all of these things related to the commercial paper is given. So it is also called unsecured promissory note because you are actually promising to give some money that is written over that particular commercial paper is something that is the thing. Now talking about this question 2022 paragraph on commercial paper, and then they have asked some questions. Commercial paper can be issued for a maximum duration of dash days. What is the right answer? Yes, if you have answered B, 365 days, that is 1 year, is absolutely right. Now next question on the same paragraph on the same year. In India, commercial paper are issued in denominations of rupees dash lakhs or multiples. I hope you know the answer for this. We have already discussed it. Yes, if you are answering E, 5 lakhs, that is absolutely the right answer. The commercial paper are issued in India in which of the following form? Okay, in the paragraph itself, the answer is given in the form of a promissory note. You are promising to return back that money. So if you have answered B, it is absolutely the correct answer. You know, this is another question on another topic. Which of the following systems is being referred to in the above paragraph? Dash is a screen-based electronic anonymous order matching system. Okay, so note the term order matching. In the secondary market trading in government securities owned and operated by RBI, membership of the system is currently open to banks, primary dealers, insurance companies, mutual funds. Okay, that maintain subsidiary general ledger account with RBI. These are designated as primary members of the system and permitted by RBI to participate directly. Gilt account holders who maintain gilt accounts with these primary members are allowed indirect access to the system, may place trades by requesting their primary members to submit them on their behalf on the system. Okay, so what is happening over here? We are talking about a platform wherein government securities can be bought and sold. Okay, so if I just talk to you about this, when the RBI comes up with these government securities, it launches these government securities through something called the e-Kuber uh, core banking solutions that the RBI has. Okay, now when the primary dealers and others have actually bought these government securities, when they have to trade them, okay, someone else has to buy them, they have to trade them. So in that case, this happens through a particular platform called negotiated dealing system order matching. Okay, so this is the platform through which this happens, and this is, as you can see, initial issue which is called a part of the primary market, and this one is part of the secondary market, NDS-OM. Okay, so through this platform these things can be done. It is screen based electronic anonymous order matching system wherein someone has ordered these many government securities. Okay, this is there with me, so that order is matched with whoever has it, and then the government securities are delivered and the cash money is transferred instead in payment to that particular government security. Okay, so banks, primary dealers, insurance companies, mutual funds who actually have this particular account opened with RBI, it is called the subsidiary general ledger account. They can be part of this particular account, this platform, and people who have gilt account. Okay, like primary dealers are those who can directly deal in this government securities through this platform. Some people who are actually having account with the certain primary dealers, that is called the gilt account. So gilt account is used for government security exchange, so they can tell them to directly access this and indirectly get access to that particular government securities when they sell to them. Okay, so this is a sort of a recreated passage. But anyway, from here there is a question: which of the following systems is being referred to in the above paragraph? Now I think you will be able to answer this question very clearly. 2025 latest question of RBI Grade B Phase 2 FM paper from the finance part. So A is the right answer: negotiated dealing system, order matching, isn't it? Now, talking about that, here comes the role of RBI and the debt market, right? How these government securities can be exchanged. So, it is a regulator of the money market already. We know RBI as a banker to the government and to the banks. It is a banker to the government and banks. We have already seen that. Now, talking about RBI retail direct scheme. So, here treasury bills, state government, state development loans, government bonds, all of these are the bonds that the governments actually can issue. So, RBI initially used to sell these things directly who could buy, only banks etc could buy. Now as part of the RBI retail direct scheme, even the individuals can buy, retail investors can also directly buy these securities, these government bonds from the RBI. Okay, so that is what is the function of the RBI retail direct scheme. So this happens if you talk about the primary market, the issue happens through the e-Kuber platform. While in the secondary market, if you want to exchange these particular government bonds, then you will have to use the NDS-OM platform. I told you already, and that is being maintained by the CCIL, Clearing Corporation of India Limited, right? RBI owns this platform, but it is being administered and maintained by CCIL. Okay, so that is the thing. So e-Kuber for the primary market, NDS-OM for the secondary market. I hope that is very clear. Now, will you be able to answer this another question on the same paragraph? Which of the following executes transactions on the NDS-OM platform? This is being asked. Is it RBI, CCIL, NPCIL, CDSL, NSDL? So obviously you will be able to answer it right now. Who is maintaining and administering this NDS-OM platform? Right, so obviously it is CCIL who will be executing those transactions. Clear? Now moving ahead, Clearing Corporation of India Limited is used to clear what type of trades? Primary market transactions in shares, transactions in government securities, primary market transactions in IPOs, all of the above, or is it A and C only? 2018 phase 2 RBI grade B question. So CCIL is a clearing corporation. It takes care whether the transactions payments are happening the right manner at the right time, and they're getting settled, that yes they are the one side is paid and the other side is also paid, all the transactions are happening properly or not. So yes, the correct answer here is mainly it is dealing with the transactions in the government securities. This kind of trade is something that it takes, CCIL takes care of. Okay, so that is the thing. So CCIL is the central counterparty since 2001 with respect to transactions in the money market, government securities. Okay, transaction of money with respect to the government securities and specifically other markets too. Okay, so CCIL actually manages something called NDS call, which is an interbank borrowing related market. Okay, so this is an online platform wherein interbank borrowings can be done. Okay, so these are called call, notice, term money borrowing between banks only. Okay, now NDS-OM is between different entities, and here what happens, the exchange of the government securities or the government securities are bought and sold and the money is transacted. Now we also know about tri-party repo, already we have discussed in this session. So tri-party repo, there is this tri-party agent. So there are two agents only which are permitted in India to become this tri-party agent. One of them is CCIL and the other is the National Stock Exchange. You be able to remember. So CCIL's role is with respect to all of these, as I have already told you, NDS call system between banks or the NDS OM system between these people, entities for the transaction of the government securities, or tri-party repo between these parties. Okay, so that is something that the CCIL is responsible with. Now moving to the forex market, here is your first question. Under the liberalized remittance scheme, all resident individuals including minors are allowed to freely remit up to dash per financial year April to March for any permissible current or capital account transaction or a combination of the both. RBI grade B 2023 question this is. So for this, you will have to have an idea of the liberalized remittance scheme first of all. So what is this LRS scheme? So if you want to transfer some money out of India in the form of a remittance, and if you want to receive some money, so this scheme is something that can guide you and provide certain extra facilities. So the first part of this is that LRS scheme actually is provided to all the resident individuals, firstly, including the minors, so that they can freely remit. Firstly, they can send some money out of India. What is the limit of money that they can send? Not about that is something that you can send within a particular financial year. Okay, what is that limit is being asked over here. So very straightforward question. This scheme, what are the benefits of the scheme? Is it INR 2,50,000, US dollar 250,000, US dollar 50,000, INR 50 or 15,000? So the correct answer is US dollar 250,000, which is the limit that you can send money. That money can be sent out of India. Okay, so that is LRA scheme, which is actually as per the Foreign Exchange Management Act. And as you know, as per the FEMA Act, RBI is the entity that actually takes care of these foreign exchange related transactions, and LRS scheme is also under its purview. Okay, it was brought about in 2004, and obviously the main aim of the scheme is foreign exchange management policy in India that allows resident individuals to remit a certain amount of money abroad for various purposes like investments, education, travel, acquisition of assets, or for all of these things you can actually send money out of India. Okay, and you could do it through this scheme which actually provides certain facilities and benefits. Okay, so that is the thing, but the limit in this particular scheme is that you can send only US dollar 250,000 per financial year. Clear? Rupee has been weakening of late and has break the level of 70. This happened in 2018. Under these circumstances, what action can be executed by RBI? Okay, so we can see rupee weakening now also. What is meant by rupee weakening first of all? So if you see $1, what is the exchange rate? If we just see right now, let's say it is 90 rupees. Now in future, if this happens that $1 is 95, we say the value of rupee has depreciated. The value has depreciated in comparison to dollar, while the value of dollar has appreciated in comparison to rupee. Can we say that dollar is much more costlier now? Okay, you have to pay 95. Previously you could buy it at 90. So we can say rupee is weakening in this case. Okay, under these circumstances what can happen? It is just like a normal trade that you would expect. Let's say in India, the initially the cost was $1 was 90 rupees. Now if you see, there's a whole lot of Indian currency that is coming into India. Let's say Indian currency, rupees, 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 so many rupees. So people would be ready to get these rare dollars to pay more. So $1 would now be higher than 90, that is 95, right? So what can be done in this particular case? If you are supplying some dollars into the economy, अरे इतने सारे dollars तो already हैं, right? I'm getting dollars very easily, so I'm not inclined to pay 95. So to ease out this situation, what we have to do, we will have to get some dollars so that the demand of dollars reduces. If the demand reduces, the price automatically comes down, isn't it? So this is what can be done. So the correct answer over here is that we are going to sell some of the dollars. Dollars come into the economy, so RBI will be using its own forex reserves and selling these dollars into the economy so as to increase the supply of these dollars and thus decrease their demand. And so as that happens, the price of the dollar reduces. I hope that is very clear. So it is absolutely the right answer over here. Okay, so RBI can actually be involved in the foreign exchange market in three ways. It actually grants the authorized dealer licenses. So if I say there are different banks in India like SBI, they cannot directly go and deal with these with the forex, okay, foreign exchange reserves, and they cannot deal with the foreign currency directly. Only if RBI designates them as authorized dealer. There are basically three categories. We will not go into the depth of it, but yeah, authorized dealer, if it makes SBI an authorized dealer, only then it can deal with these particular foreign currency, okay, be it various kinds of trades or just simple exchange of the currency. Okay, so there are different kinds of licenses based upon the category in which category authorized dealer RBI is designating these institutions as. That is first role. The other role is that RBI maintains its own foreign exchange reserves, and it also intervenes whenever the in foreign exchange rate goes up and down. Okay, there are different market forces because of which there might be change in the exchange rate. One US dollar changing to charged at 75 Indian rupee, it can change, the exchange rate can change $1 to 100 rupee. Okay, this can affect the Indian economy in a very bad manner. Okay, so what can happen actually because of this, that is that the forex is actually costlier for us in comparison to any other country in that case. Okay, so this should not something is something that we should happen. Okay, we have someone, whom do we have? The Reserve Bank of India. It will not allow rupee to fluctuate more, provide stability to rupee, so it will be buying and selling these dollars. Okay, so when this happens, then for RBI has its own reserves of forex currency, so it will be selling the dollars into the market so that the demand for these dollars reduces and the price eases down to, let's say, 90 rupees, 80 rupees, like that. Okay, so the opposite can happen in the other case. So these are the things that it can be doing. Now RBI will sell the foreign exchange in case of depreciation, like $1 is equal to, we have seen, 90, it becomes 95. So as to ease out situation here, it will start selling dollars, so the demand of dollars will increase and the prices will reduce. $1 is equal to, let's say, 92. In the case of appreciation, it will start buying the foreign exchange. Okay, so the reverse happens over here. I hope that is very, very clear. Appreciation, the other thing happens. Okay, so we have seen this very clearly. Now moving to the next chapter, that is alternative sources of finance. So here the first question is, which of the following is an example of alternative sources of finance? So if we talk about the alternative sources of finance, we have certain traditional ways in which we finance our activities, isn't it? Traditional ways, tell me what can be some traditional ways. If I say a company needs some money so as to expand, what would it do? Traditionally, it would go for taking a proper loan. It might go for issuing some shares or issue some bonds. Okay, so these are the basic traditional ways in which this can be financed, isn't it? Now there are alternative ways in which this thing can be done. They are called the alternative sources of finance, right? So that these can also be done. For example, over here it is given as forfeiting. Okay, so this is a process wherein, let's say, there is a seller and there's a buyer. So the seller sends some goods to the uh, buyer, let's say internationally, he's in USA. So in that case, buyer says, I cannot make the payment immediately, or the transaction itself takes a whole lot of time. Okay, as and when the buyer receives those goods, he'll be making the payment, but it takes time because it has to be transported to that particular person in the other country, isn't it? So this during this time, the seller is actually out of resources, right? He has to carry on with his manufacturing and paying the salaries, daily wages to people, so he does not have the money for doing that. So this seller actually approaches a particular bank and says, by, please help me with this particular thing. Okay, so this bank would say, okay, we will go for a forfeiting transaction, wherein whichever bill the seller has submitted to this buyer, same bill will be submitted to this bank, and the bank will actually give some money. Let's say 100 rupee bill, bank will be giving, let's say, 100 rupees to the seller while taking a fees separately. Okay, so कान ऐसे नहीं ऐसे पकड़ने वाली बात है, but yeah, the bank will be profiting from this, and the bank will go and contact to the bank of this buyer, right? And then there is, all of the details are taken by the buyer's bank, and the buyer's bank actually issues something called a avalized bill of exchange, right? So it says that, okay, everything is fine, and I am issuing this particular this bill of exchange is actually avalized by me. So bill of exchange will be submitted by this bank on behalf of this particular seller. Then it will be avalized. Avalized in the sense everything is fine, and now we can move ahead with the forfeiting transaction. So the bank will actually move ahead and say, okay, I have paid the seller. Then the buyer will finally pay to this bank through this particular seller. Okay. So this bank has the responsibility of paying initially, number one. Number two, also getting the collection of that particular money. So this is an alternative way. इधर उधर जो है कान ऊपर नीचे घुमा के हमने ये पैसे लिए. ओके, so that is what is forfeiting. While if you see overdraft, government security, bonds, bank loan, all of these are the traditional ways of getting finance. So E is absolutely the right answer. If you have answered E, you are absolutely correct. Okay, so there are various ways, like leasing is another one, wherein you are not going to actually buy a particular product, you are just taking it at rent. Okay, like for example, if you want to go for a ride over a mountain or something, you won't be buying a car for that, isn't it? For that only purpose. Okay, might be for your personal purpose you can, but for that purpose only you are not going to buy. Of course there are other freaks who would definitely buy for that purpose, they have a whole lot of money. But yeah, the thing is, you might rent a bike, rent a car, travel there, return it. That's called lease, simple in simple terms. Okay, whenever you rent something, it is known to be lease. For example, if there is an airline company like Ratan Tata G's wonderful company Air India, if they want to get a aeroplane and they are not wanting to buy it because it costs a whole lot. Okay, with respect to bike and car we may not be able to understand, but yeah, aeroplane it costs a whole lot. And yeah, what they're thinking is we'll take that aeroplane for 1 year on lease from Boeing. Okay, so this is something that they can do very easily, and they will get it on rent, they will be earning from it, and then after 1 year they will return. While in the time in between, they have either paid the rent of 1 year, or they will be keep paying the rent of 1 year every month or something like that. So that is called leasing, taking things on rent basically. There are various kinds of it, but yeah. So similarly, we have franchise, wherein let's say some person has taken all the activities that a particular company is doing, same activities, like mostly with the food industry or some industry wherein some products are sold. Okay, so you take a franchise and then you are selling those products and then getting finance. Some part, some money you will be keeping, and some money you'll be sending it to the company, isn't it? Then factoring, like we discussed, forfeiting, isn't it? In the example, this we said international. Similar thing if it is happening within a particular country, mostly domestic factoring is, so that will be called factoring. Forfeiting already we have discussed. Like crowdfunding is wherein you can sort of bypass the regulation. Not crowdfunding is not totally regulated, although some parts of it RBI SEBI they regulate. But yeah, so crowdfunding happens wherein you are getting funds from a whole lot of people. Okay, you are giving your idea, people like, and people donate. Okay, like 1 crore people have donated for it, you get a 1 crore just like that. That is crowdfunding. Angel investor, venture capital, who help startups, right? They provide finance to the startup. It is sometimes called they go with their pitch, like you must have seen Shark Tank. Okay, so there they go with their pitch and they will be telling, okay, we like your idea, we'll be paying. So there is one investor or group of investors who will be investing in this particular venture. Then peer-to-peer lending is wherein people who need loans, who have loans, they will be connected through a particular website. So that might be a peer-to-peer lending website. So that is the thing. Which of the following statement is false with respect to peer-to-peer lending? So here, peer-to-peer lending gives higher rate of interest for the lender. Peer-to-peer lending is not regulated by RBI. It leads to lower rate of interest for the borrower and higher rate of interest for the lender. Peer-to-peer lending is legal in India. So it is legal in India. Yes. Okay. It here there is no higher lower rate. Whichever rate you feel right, you can go for that and borrow from whomever you want, because there are various options of taking loan, giving loan. It is regulated by RBI. You cannot say it is not regulated. So B is actually a incorrect statement. So talking about that, let us say there's a person who needs 20,000. He goes to a P2P platform. Okay, I'll give it at 5% interest for 5 months. So that platform is called a peer-to-peer platform. Very simple. Okay, you see so many websites where you can take loans. You get many messages, right? So these platforms are actually those which connect the borrower and the lender. That is called a peer-to-peer platform. Okay, so here interested lenders are connected to the borrower. That is what is a peer-to-peer lending platform. Bank is not required over here. Bank entity might be one of the lender, but yeah, bank is not doing its activities to uh, give the loan. The platform itself is doing all the marketing and stuff so as to connect them. It is a faster process and there is less requirement of paperwork over here. The advantages to the borrower include instant funds. There is no collateral, low rate of interest is getting this, whereas the lender has some idle money, so that money is getting used up right now in a very institutional manner. Also, it is regulated by RBI, so nothing to worry about it, right? RBI directions of 2017 regulate them. These platforms actually have to get themselves registered with a certificate of registration with RBI. They have to register as NBFC, non-banking finance company, P2P, which is peer-to-peer lending. It is like a company incorporated in India, and their net owned funds should be not less than 20 million rupees. Okay, so they should have like these many million rupees with them, only then they can go for coming up with such a platform. Is that clear? What are the ways to raise capital via online mode where you can bypass the regulation? Not as such totally bypass, but yeah, this solution came in RBI Grade B Phase to 2018. Some parts of them can be bypassed by crowdsourcing, is something that I already told you. Crowdsourcing or crowdfunding. Okay, so what is this crowdfunding? Let us say this person has an idea. Okay, he says here is a cooler. It includes blender, waterproof Bluetooth speaker, USB charger, cutting board, bottle opener, a perfect thing that you can imagine as far as you go, let's say in a car or even in a bike, you can carry it behind. You have such wonderful bikes now. So, and go over mountains, and then you don't find many things over there. Just take some of the fruits and make a juice or something, and then you can also cut things, and like you have taken some uh fruits and all, you can go for it. Okay, blender, bottle opener, everything is there in this, so it is a combo of all of these things, perfect for your rides. Okay, so there's a wonderful idea, but he does not have much of money to scale it up at a mass level, go for mass production. So he asked many people, this is my idea, will you be helping me with this, right? So if you help, I would be able to scale it up. So people feel ये ठीक है जी, बहुत अच्छा है ये, you should help this particular person. So in this way, this kind of a project actually, this person called Ryan Grepper, you can see him over here. He raised around 13 million US dollars from this, from 60,000 backers in just 52 days. Can you imagine that? That is crowdfunding and the power of it. So crowdfunding is fundraising method that harnesses power of collective group. They are paying for this particular thing. A little money, lot of people. It is a whole lot of money. Okay, so that is what is crowdfunding. Now, moving ahead, we'll be talking about this particular kind of financing and factoring. We discussed what factoring is. In that, we have a institutional mechanism where in a particular problem of the micro, small, medium enterprises is resolved through a platform called trade receivable discounting system. Okay, so what happens, MSMEs are actually they come up with certain wonderful products, but the government departments, and to increase the buyers, government departments and certain companies also, they have mandates so as to buy things from MSMEs only. More so with respect to government departments, they have mandate from the government that they have to buy things like government department needs some uh, stationery, it will buy from the MSMEs only, so that is their mandate. So they will procure in this manner, and in that case, many a times the government departments are not able to pay these MSMEs back at the right time. So in that case, what is to be done? What are the options that the MSMEs have to resolve this issue? One option is the Threads platform. The MSMEs will be uploading this whatever bill they have generated with respect to the government department. So this bill will be uh, over this particular platform. Now the bill, let's say 100 rupees bill, will be converted into certain factoring bids, right? Into parts like 50 rupees is one bid, then 30 rupees another one, and 20 rupees another one. Like that, so many financiers who can be banks and non-banks will be participating in financing this particular factoring process. Okay, so over 50 rupees there will be bids, like there will be so many banks. Let's say one will say I'll give 49, one will say I'll give 48, one will say I'll give 45, because that is a factoring, you will discount and pay, isn't it, 50 rupees. So yes, the MSME likes this bid best, so it will select this one. Then over 30 rupees, let's say we have 29, 28, like that. So 29 is the best bid. Like that, best bids are selected, and the MSME says, okay, here is my bill, it has been converted into factoring units, and you people will be getting the final payments from the government. Okay, so government will pay the full amount like 30 rupees, and this particular bank or entity NBFC has actually paid 29, so it is going to gain some profit out of this. Government department is also getting some time to pay back. MSME is getting its money. Is that clear? So this is how the trades platform works. So we see so many participants over here. We have the government department, we have the MSMEs, we have companies also. These are the buyers, this is the seller, here are the entities who are actually financing this particular trade, and the trades platform is maintained by a particular entity who is the service provider. And apart from this, new entity called insurance companies have also been added to this trades platform. So that is the thing. Now moving ahead, here the question says a digital platform that enables MSMEs to discount their invoices is regulated and controlled by which authority? Okay, so I think you can guess, considering all of these activities, who actually regulates this particular transaction. So obviously it is Reserve Bank of India, because banks and NBFCs, their financing is included over here. Factoring is a process regulated by RBI. Okay, clear? So that was what we spoke about, factoring and the trades platform already. I hope the things are clear here. The MSMEs will be uploading the particular invoice. There are various entities who will be bidding on that, and they will be paying on the factoring units. Okay, so this way the trades platform works. Now please answer this question. Trades enables MSMEs to obtain liquidity by facilitating discounting a trade receivable from sales to corporate and government buyers. Absolutely yes. Platform addresses issue of delayed payments to MSMEs. Yes, this is also right. And the third one, it trades entities are recognized as market infrastructure institutions. Okay, so market infrastructure institutions are those entities who are regulated by SEBI, and they are part of the capital market. Okay, so we are not talking about the capital market over here, alternate sources of financing. So they are regulated by RBI. So obviously the third statement is incorrect and the other two are right. So B is absolutely the right answer over here. I hope that is very clear. Now please answer this question. Describe settlement mechanism under trades. How the settlement mechanism is carried out. Settlement of funds on trades is carried out through RBI regulated payment settlement system. MSME receive payment only on the invoice due date, not at the time of discounting. Finances recover funds directly from MSMEs in case of buyer default. Settlement timeline on trades are determined by mutual agreement between MSMEs and financiers. Trades operates outside the formal financial system to reduce regulatory burden. This is not correct, right? So obviously we can say the settlement happens as per the RBI regulated payment and settlement systems. Okay, so generally RTGS or something, the settlement happens. So that is the thing. A is absolutely the right answer. I hope these things are very clear. Moving into the next chapter, that is banking system. Here is the first question. Bank X has a foreign account with Bank Y in Bank Y's home currency. For X, this account is called as what? Okay. So if we talk about this particular question, let's say there is SBI Mumbai. SBI Mumbai has opened an account with Citibank New York in New York. Okay. So this account is actually referred in different ways by different entities. Like SBI Mumbai calls it a Vostro account. Okay. Sorry, it is called as a Nostro account by SBI Mumbai. Okay, Nostro in the sense our account with you. Okay, like that. So it is a Russian term, but SBI Mumbai in its particular books writes this account as Nostro account, while Citibank New York will be writing that account as Vostro account. Okay, again a Russian term, right? Vostro in the sense your account with us. Okay, like that. Now let's say we have another entity, some other bank, American Express Bank, and it is referring to this particular account. It will call it a Loro account because it is an account of SBI Mumbai in Citibank New York, and this is a third party. So third parties call it Loro account. Is that clear? So there is no Potro account. So the correct answer over here would be what? Bank X has a foreign account with Bank Y in Bank Y's home currency. Bank X, this account is called. So this is X. It has account over here, and what will it call it, this particular account? So the correct answer is what? Yes, it is the Nostro account. I hope that is very clear. I've explained this thing to you that if SBI Mumbai actually has its account as Citibank New York, it will call it a Nostro account. Our account with you in the books of SBI Mumbai, it is Nostro, while it is a Vostro account in the books of Citibank New York, your account with us. Okay, now a third party would call it a Loro account, their account with them. Is that clear? That is the thing. Now moving ahead, which are the following types of banks act as Government of India agent for financial inclusion in rural areas? So which kind of bank? Banking correspondent, it is not a kind of bank. Private bank, public sector bank, regional rural bank, or CRR balance. CRR balance already we have seen, that is a kind of a balance that the banks have to maintain. Now the options for us is private sector bank, public sector bank, and RRBs, which are themselves called the regional rural banks. So obviously the here it is very clear, not much of an explanation required, that financial inclusion in rural areas is something which is carried out by the regional rural banks. Okay, so how do they carry out this financial inclusion? Let us have a look at regional rural banks. These have been recommended by M. Narasimhan Committee. Okay, 1970s one Narasimhan Committee was also established. So they recommended 76. We came up with this Regional Rural Bank Act of 1976, and then we established them. These are government owned scheduled commercial bank, let me tell you. Okay, so scheduled banks in the sense what? These are the banks which are mentioned in the second schedule of the Reserve Bank of India Act, and then commercial, they are mostly for profit. But yeah, regional rural banks are less towards profit, and they generally aim for serving the rural enterprises and people and their credit requirements. Okay, so they, how are they actually serving? Okay, how can we say in the rural areas they are actually helping? So the PSL target for the regional rural bank is quite high, 75%. If you see, scheduled commercial banks and foreign banks actually have a target of 40% of the ANBC and COBSE. We know that. Now if you see small finance banks, it is 60%, right? But regional rural banks have a highest target, 75%. That means whatever loans they are giving, most of them should go to the priority sector, and more so in the rural areas these priority sector are. And rural areas we have agriculture related entities and various other entities who can take advantage of this. So they are actually helping in providing more and more credit in the rural areas itself, which is actually helping them to get included into the formal financial system, isn't it? They are restricted to few districts only, like Baroda Gramin Bank branches are in Gujarat southern districts only, like that. Ultimate regulator is RBI, while the supervisor is NABARD, and their financing structure is also very wonderful. They have a 50% shareholding of central government. There should be a bank that sponsors them, like SBI sponsors, let's say this Baroda Gramin Bank, then yeah, that will be established. So there should be some sponsor bank only, then it will be established, and the sponsor bank gives a 35% uh, of the funds, while state government gives 15% of the funds, like that. Okay, so here if you see Uttar Bihar Gramin Bank, the sponsor bank is Central Bank of India. Is that clear? This is how the regional rural banks are established, and this is how RRBs actually contribute in the financial inclusion of these particular rural entities. Now moving ahead, in the world of finance, it has been seen what is hypothecation. Only possession of asset is transferred, ownership is transferred, possession, ownership is transferred, possession, ownership both are transferred, none of the above. So for that sake, you should know whenever a loan is taken, let us say there is a bank who is actually providing this loan to an entity, a person X. Okay, so in that case, this person X has to give either some security or transfer some collateral, right? So that is what this person X has to do. So in this case, whenever there is immovable property, right, that the person X has, generally something called a mortgage is done. Like if he has house, so he will mortgage his house, right? While mortgaging the house, he will be telling, there will be different types of mortgage, wherein in some sort of mortgage the entire ownership of the house is transferred. In some sort of mortgage the house papers are transferred. In some sort of mortgage nothing is transferred, but there is a deal. But yeah, that is called deed, in fact, right? The title deeds are transferred, or mortgage deed is signed separately. Okay, so in that case, the possession of that particular house can be taken if X defaults on the loan. This is with respect to immovable. Like if we have any movable property like gold, in that case gold is pledged. That process is called pledged. Okay, pledge, we pledge gold to the bank. Well, if you have something called, if you're buying a bike, okay, and with respect to that you want a loan, so in that case you will have to go for something called this hypothecation. Okay, so hypothecation in case of movable property, it is used. What do? We do not transfer any ownership, we do not transfer any possession. The bike is used by you only. Whatever business you are doing, you will only earn. But if you default, then you promise to pay by either utilizing that asset or giving it to the bank, something. Okay, so Neither possession nor ownership is transferred in hypothecation. So that is the right answer over here. I hope that is very clear. So in hypothecation, let us say 3 lakh loan you are getting and you have to buy the bike at 4 lakh. So 1 lakh is something that you're paying on your own. Okay. So possession and ownership remains with the borrower. This is your bike and you can utilize it. Possession means you can use it. Ownership is whose bike it is, whose name it has been bought. So both things are yours, but if you default, then you will have to pay with this particular bike itself. That is the thing. Next, moving ahead, which of the following is a non-fund based transaction? So for that sake, what are these fund based and non-fund based transactions? In fund based transaction, basically the funds or the money is transferred. Like if a bank is giving loan to someone, bank is taking deposit from someone, bank is actually issuing some credit card, it is giving an advance, isn't it? Or like that, all of these are actually fund based, wherein physical money is actually transferred, large amount of it transferred between bank and other entities. Well, there are non-fund based facilities that the bank might be providing, non-fund based transaction that it might be doing. What are those? These are also like bank gives bank guarantee. What does that mean? Let's say X has taken loan from Y, bank gives a guarantee with respect to X, on X paying some money to bank, some fees to bank, that if X does not pay to Y, then bank is going to make that payment on default. Okay, so that is bank guarantee. If such a kind of a guarantee is given in international sphere, sometimes it is called letter of credit. Okay, so these are the things wherein bank is actually involved and it is not paying something immediately. But once the crystallization, that is the default happens, the bank has to pay. That is called a non-fund based transaction, wherein funds are not transferred as such. But if there is a default, which might happen rarely because bank has checked everything, so then bank has to transfer money. So recurring deposit, fixed credit, cash credit, all of these are part of the normal fund based activities, while letter of credit is a part of the non-fund based activities. I hope you have understood. So D is the right answer. So having a look at that, there are various functions that the bank carries out. Primary functions are accepting deposit, giving loans. So these are called fund-based lending. Secondary functions include agency function and utility, where bank becomes an agent for different collection of bill payments and all of those things. While it provides utility functions like issuing checks, demand drafts, etc. Then there are also miscellaneous functions like it issues bank guarantee, letter of credit. It also does underwriting, wherein if at all some company has issued some shares and the requirement is that 90 shares have to be bought, but only 80 shares people have bought, public has bought, and 10 shares are not getting bought. So because of that, the IPO or the FPO, the issue might get cancelled. So this bank actually acts as an underwriter and buys these 10 shares so as to fulfill that condition, and the shares move out into the market very well. That or other credit guarantee facilities. Okay, so these are non-fund based facilities. I hope that is very clear. Now moving ahead, here is another question. RBI introduced new category of bank especially designed to address financial needs of underserved sections. Institutions establish improved financial services rural and semi-urban areas, and the banking infrastructure is limited at their providing support to small and marginal sections, including micro, small enterprises, unorganized sector workers, lower income household. The banks are required to provide credit and savings options tailored to the needs of these individuals. Primary goal is to fill the gap in financial access for these communities. Despite being smaller in scale, these commercial banks' objective of these banks is, however, not small. Okay, so from the name itself, you can slightly try to understand which kind of a bank is being spoken about over here. Okay, so reading till here, I think you would be clear that it is being spoken about the small finance bank. Okay, so name has small, but it is not small. Everything is written over here. 2024 phase 2 RBI grade B exam. So from the paragraph also many times you can identify, and the things over here given are something wherein the bank is giving small amounts of finance. Okay, so that is small finance bank. Regional rural bank of course helps in the particular areas, rural areas, but since small word is emphasized over here, it should be small finance bank, not microfinance or cooperative. So small finance bank, what are the features? Let us have a look at it. So small finance bank is one of the differentiated bank which was recommended by the Nachiket More committee. Okay, so you can remember these differentiated banks as more banks. Okay, then you will remember that yeah, they it was recommended by Nachiket More committee. So more banks, why there are so many types of banks, more banks have been recommended by this committee. So these are differentiated banks, two banks, that is payment banks and small finance banks. So we talk about the small finance bank. There's a niche because they actually cater to small finance. Okay, whoever wants small finance, the uh, that is the main thing. The main objective is to give loans to the small business, micro, small enterprises, unorganized sector entities, etc. They can later on be converted into a full-fledged bank. The core function is to lending and credit dispersal to these entities. Mainly, the activities include those issuing loans, and the priority sector lending target is also slightly higher than the normal commercial banks, scheduled commercial and foreign banks, which is 40% of A and BC or C or BSC. Apart from that, main feature of small finance bank is that their loan portfolio is majorly having small amounts of loans. That is 50% at least, whatever loans they give, the size of those loans should be less than 25 lakhs. Is that clear? And also their branches are established, 25% of them, in the unbanked rural areas. So their existence is also in these far off places. So that is where small finance banks, as the name suggests, they help in the rural areas. Now, please answer this. What is the primary aim of these banks? Okay, maximize profit, no. Expanding international operations, no. Serving the financial needs of underserved populations, investment banking services, corporate finance. Please tell me what is the main role. You can very properly answer this now. I hope yes. If you have given the answer as C, you're absolutely right. Another question: banks mentioned in the passage primarily cater to which particular groups? Large corporations, high net worth individuals, small enterprises, low income households, government agencies, yeah, foreign investors. So obviously, small finance banks, they give small amount of loan. They should be catering to small enterprises and lower income households. C is absolutely the right answer. Absolute question from 2024 phase 2 RBI grade B, and this is a paragraph based question, very easy to answer. I hope you are able to do that. Now, one more. In addition to providing financial services, these banks also contribute by. So you can see so many marks you have gained over here if you have just read one concept very properly. Reducing reliance on the foreign investment, promoting financial literacy among underserved communities, offering competitive interest rates, increasing automation in urban areas, supporting only high yield investment. So obviously, promoting financial literacy. What is the aim of these small finance banks, regional rural banks? Is financial inclusion, and the part of it is to promote financial literacy. They should have information, knowledge of all of the services that they can avail as part of the this particular kind of banks. And the financial inclusion initiatives that these banks and government of India take. So that is what is called the financial literacy. So B is absolutely the right answer over here. There's one more question you can see over here based upon one of the committees which is related to the banking sector. You can see Government of India initiated comprehensive reform process in financial system 1992 to 93 following recommendations of Committee on the Financial System 91. As part of second phase of reforms, another committee was constituted December 97 under the chairmanship of M. Narasimhan. The committee focused on strengthening the banking system through improved regulation, competition, efficiency. Okay, so M. Narasimhan committee, and we are talking about the second phase of reforms that were brought about by the M. Narasimhan committee. Okay, so what can we say? These reforms actually emphasized on banking sector reforms, prudential norms, market-oriented monetary tools, recommended greater participation of private and foreign banks, also direct control. Instead of direct controls from direct controls, indirect instruments of monetary policy should be utilized, was something that was recommended. So which of the following statements are correct with this particular, as per this particular paragraph? So here we are talking about the Narsimhan committee 2. So Narsimhan committee 1 was established in 1991-92. It gave its report. So we can say at this time there was a whole lot of turmoil going on in the financial sector of India. We didn't have the forex reserves we required, and we had to go for the LPG reform. So that such a thing does not happen again, we came up with various committees, and for the financial sector we came up with the Narsimhan committee 1. M. Narasimhan, he is a former RBI governor, so under his chairmanship we came up with various committees. So this committee recommended things related to the financial sector. Now, if we talk about Narasimhan Committee 2, again this committees was asked for some advice, right? Some recommendations, and this second committee actually recommended with respect to the banking sector very specifically. Okay, so banking sector reforms related this committee was established. Please remember that. Now, the committee referred to in the paragraph is Committee on Banking Sector Reforms. The recommended licensing of new private banks, domestic and foreign banks. Committee recommended continued reliance on CRR as a primary tool for liquidity management. Obviously, the options are difficult. You should know about these two committees only, then you can answer. So second committee, as it is being suggested, it encouraged more participation of the private and foreign banks, right? Apart from that, as you can see, shifting from direct to indirect tools. Okay, monetary policy, liquidity management, managing the money. Direct tools are like things, the interest rate has to be reduced, or like that. These are very direct tools wherein the interest rate will be reduced in the market and then money will flow into the market, more loans will be taken, like that. So CRR and all are indirect tools. Okay, so what can we say over here? One and two only, because yeah, CRR also is something which would reduce the interest, would actually make variations in the amount of money that is going into the economy. So a shift from CRR and these basic interest rate based monetary policy was something that was recommended by this Narasimhan committee too. So obviously one and two only, B should be the right answer. Talking about history, Narasimhan committee one recommended reduction of the reserves. It is committee on financial system. Okay, entire financial system after the 1991 basic reforms that we carried out, LPG, were based on this particular committee. Reduction of the reserves of the banks and interest rate should be determined by market forces. Private sector banks should be allowed. Adopting international banking standards and also going for Basel type regulations was something that was recommended. Okay, so all of these mainly related to the bank, and here international activities related recommendations have been given. So that we should adopt international banking standards, also go for Basel type of regulation, right? Wherein Basel norms are for all of the banks all over the world, wherein what should be main aim of Basel norms is to maintain at least a level of capital which with which the banks can function in a proper manner. Okay, so that is the main thing. So these were recommended that should be implemented in India also. The Narasimhan committee was brought back in 1998, a three-tier banking structure wherein three to four very large banks are there with international presence, 8 to 10 national banks should be there, and several regional and local banks should be there. This was a three-tier structure recommended by this particular committee. Also, banks should be provided greater autonomy, not government should not interfere within their working. Capital adequacy, asset classification like NPA related norms should be tighter and strict. Banks should be consolidated and merged if required, and the liquidity adjustment facility was recommended by them. We have discussed in the beginning part of this video, right? So these were the things that were recommended by the Narasimhan committee too. I hope that is very, very clear. Now please answer this one also. Dash was introduced on the recommendation of the Narasimhan committee to manage liquidity through indirect monetary policy instruments. Okay, so what was recommended later on? So yes, liquidity adjustment facility was recommended by the Narasimhan committee in 2025. I hope that is very clear. Moving ahead to the last chapter, RBI and its functions. Over here we have one question: what is the ways and means advance limit for the second half of the fiscal year 2024-25? Of course you might not be able to know the limit for this, but at least I just wanted to show you that this kind of a questions are asked from here. Ways and means advances, if we talk about that, then ways and means advances is something by which if governments want to take loan from RBI, they can go for taking that loan from the RBI, okay, through the ways and means advances. There are different kinds of them. We'll talk about those normal and special ways and means advances, but the basic idea is that they can take loan. Now there are limits with respect to these ways and means advances, how much in a particular fiscal financial year can be taken by the government of India. So what is that limit? So that is being asked specifically. So here the correct answer actually is 50,000 crore. So let us have a look at this ways and means advances. So these are temporary advances. Central and state governments both can take for 90 days time period is the maximum mostly for this. Okay, within 90 days it has to be returned. Two kinds. First of all, the whatever government it is, it will take a loan through the normal ways and means advance, and then if it is unable to fulfill the requirements of the government, it will go for the special ways and means advance. Now normal ways and means advance, whenever reserves or the money that the government has is not sufficient, okay, in that case it will be taken. And here special ways and means advance, what can we say? deficits and cash flow mismatches by utilizing government reserves, right? So to bridge all of these, the special ways and means advances are actually taken. Okay, so whenever government of India has some deficit, it is unable to match between its expenditure and income. So in that case, this loan will be taken. So this is unsecured, while this is a secured kind of transaction wherein government securities are required. Okay, fixed amount over here, and this is dependent upon the whatever value of collateral you are bringing in. That value of loan can be taken by the particular government. It is charged at repo rate. Here the charges are repo rate minus 1%, lower interest rate over here. So this is a facility that you'll be utilizing first, and then you will go for, after this has been exhausted, you will go for this particular special ways and means advances. Okay, or also called the SDF. Is that clear? So ways and means advances for central government, the limits are actually decided by RBI in consultation with the central government, as we have seen in the previous slide. Question came on that. So specific yearly limits you should know about the this particular thing that the governments utilize. Okay. So those were the things we had to discuss. I hope you liked this session. Of course, it is slightly lengthy, but yeah, we had discussed so many questions, so many topics that are very important for the upcoming exam. Hope you have understood all of them, and let me also tell you that definitely if you are requiring any help with respect to your preparation for the RBI Grade B exam, we have come up with wonderful courses in that regard. We have the a wonderful live crash course with respect to phase 1 and phase 2 combined, wherein live classes will be the source through which you will be getting idea of all the most important topics with respect to the different subjects of these particular exams. You can be part of them. Okay, there are solved previous year questions, chapter wise full and test also over here. Phase 2 live crash course we also have over here. Here the live classes are being conducted wonderfully. All the topics are being taught to you in the live classes. You can ask doubts live right then and there to the mentor, right? Summary sheets, mind maps, current affair magazines, all previous year questions, chapter wise current affairs, full length mock tests are also part of it. Also we have wonderful test series. If you're like confident with your preparation, you can go for phase 1 plus 2 test series or just phase 2 test series. Okay, there are wonderful discounts also given on these particular courses, and so keeping all of these things in mind, you can definitely be part of these specific courses. Okay, so wishing you all the best. If you have any other query, you can always let us know on this particular number or drop a mail at hello@edutab.co. Thank you so much.